Hey man, isn't the S&P 500 supposed to be a clean, simple investment that anybody can do nowadays just to make sure that their money isn't getting murked by, right? We know that on average it's supposed to yield a minimum of 9% a year. We know inflation doesn't get that high, so the difference is the earnings, right? So we get assuming expected or intended inflation rate of 2%, and we get the average returns of the S&P, which is around 8%. We delta the two and we get something around 7, somewhere between 6 and 8% of pure returns. But because of all the crap that's going on right now, we saw the S&P 500 decline. And depending on where you had purchased, initially first purchased, and how high you are in terms of your finances, this is super important. If it falls and you're on the wrong side of finances, then you're kind of screwed. You kind of want to sell everything when you shouldn't. If anything, when the prices go down is when you want to. But anyways, that's what I want to talk about in this video is essentially cover what has been going on to the S&P 500, and we know what's been going on nowadays with this war, with the oil prices going from about 60 average now 100 plus, and how stagflation is the thing. And we know stagflation is, the economy is slowing down. So stagflation is pretty much a stagnant economy. The economy either slows down or it stalls. Plus inflation is high, so this keeps prices high, and unemployment is also high. This means that jobs are weaker, so many people don't have enough purchasing power. And all of this means is that this is super important, and it's a big deal because these things doesn't happen together. It's either one or the other. Either we have continual economic growth and low unemployment, and then we also have high inflation, or the opposite. We have low inflation, high unemployment rates, and the economy is getting screwed. So how do we resolve for this? Well, that's a different story. Because the logic behind stagflation is the economy is struggling, everything is getting more expensive. This puts policymakers, or specifically the Feds, in a very situation. They have one or two options. First is to raise the rates. When we raise the rates, that helps to fight inflation but hurts growth. So that means in terms of growth, what that means is just still high unemployment rates, because it's hard to invest when money is expensive to borrow, like mortgage rates, for example. Lower rates means that we are able to help the economic growth in terms of companies borrowing money, and borrowing money leads to more budgets open for higher employment. But the issue is that because there's more money in circulation, there's more money being passed around, that worsens inflation. So how does this all make sense and tie into the S&P 500? Well, a couple of things. It's more of a macroeconomic issue that's going on right now. So it all ties in together. With the geopolitical tension increasing, we have oil prices going up. When the oil goes up, costs also increase across the entire economy because a lot of things depend on. And this, at the same time, this slows growth because it's more expensive to do the exact same thing that any person was do back in the day, because it's more expensive to do the same basic activities like work, buy certain things from the groceries, etc. All of these items, all of these activities have gone costly. So this slows growth. This combination starts to look something like stagflation, like I mentioned earlier. Because what we're seeing right now is the companies face a higher cost because of what I just said. Oil is the basis of a lot of activities. Because companies have faced a higher cost to produce the same activities that they do for the day-to-day, then that means consumers have to spend less to get the same, or even less of utility from whatever activity they do, whether it be entertainment, whether it be necessities like grocery shopping, etc., whether it be just going to work. You have to do less of it because things are a lot more costly. All of this means that profits for myself, for yourself, and for companies, it starts to shrink. Profits in terms of, from its that very definition, revenue minus cost. Every one of us who earns money and spends money has some revenue minus cost, and the difference between those is our net income, whether it be positive or negative. What I'm saying here is that we all impacted by this crap, and it directly impacts our. So now it's time to bring it back. What am I really trying to say to everybody who listens to me? Well, it's simple. If you own stocks like the S&P 500, if you own oil stocks, if you own energy, which is the broader term, if you own groceries, etc., then you have seen that because of the way the markets have reacted, you really feel it. You really feel it in terms of unrealized gains and the psychological effects that comes with looking at so much red oil. What does this mean for you? Well, like how I said earlier, it depends at which side of the spectrum are in finance. Are you on the one side of the spectrum where you're heavily leveraged, where you have a lot of debt, whether it's with consumer or car or student loans? If you have a lot of overhead costs, if you have to spend a lot of money to maintain your lifestyle, then you are certainly most in a situation, because we have experienced a shrinkage of our take-home money in terms of after all of our initial costs. Then it starts to become a bit heavier and tighter. You start to feel it maybe in your chest when things get a bit too a bit too much, where you really can't do much. You just have to brace yourselves and just stay ready. Now, in terms of psychological, when you see a lot of red and when you see your portfolio go down thousands of dollars, then that's where it starts to get heavy. Now, I'm not a financial advisor. I don't want to pay anybody money. So this is what I would do if I were in such a, because I know and I've seen and I've experienced this multiple times since I started investing over the past 5 to 6 years, is whenever the market goes down, it'll eventually go up and it'll skyrocket. And what does this mean? This essentially means is that because we are in such a heavy, if I'm speaking from a heavily leveraged point of view, but I also know that markets eventually return to their original rate before the crash and explodes even higher. But I'm also trying to take into account my high overhead, whether it's because I have a family, whether it is I have certain expenses that I just can't miss. Then you start to put things into the back. You kind of do a couple of things. You kind of sell everything, which is what I don't recommend. You kind of get a second job, but that also depends if you have enough time to dedicate to it to get a second. But this is a point. This is the situation that I put in because of the economy. And the best thing that we can do is to brace and prepare for certain situations like this. We shouldn't be overly leveraged because that means we're just screwed when things go south, especially when we get fired or laid off because of the current layoffs that it has. But what I do know is that everybody their own approach to resolve situations according to their own needs. So in other words, do what you gotta do. I would prefer if I were in that situation, I would stay with my current investments and pay off my loans and just brace through this economic nightmare that we're all experiencing. But if I were on the other side of the spectrum where I don't have loans, I do have a strong financial basis, and I also do know that I have a lot of responsibilities that I have to take into account because it's just not myself that is being impacted by my actions, then at least what I'm saying right now is that I am in a better financial situation to handle, embrace, and tackle the hardships that we all face universally. Because a 5-10% increase for me is same throughout, but the way that one person is able at that 5% increase or 10% is directly connected to how they handle their finances. If you are not able to handle 10% increase in whatever commodity that you know buy, then you will notice the price difference, and you will say, oh my god, this increase is gonna screw me over. I'm gonna have to take money from another part of the budget in order to satisfy this. Whereas another person who's more financially sound would say, oh, okay, that means I would have to save a bit less this month because there's a bigger piece of the pie in my budget that's screwed. So there are two sides of the spectrum here. How does this correlate back into the S&P? Well, this correlates back into the S&P because of the overall conflict, which is being screwed. So what I would say when it comes to the S&P, if you don't need to sell it, then don't sell it. The S&P slips because these tensions rise. Recently, it's been down 5-7% from its high. But what's interesting to know is that Boo isn't the problem. Boo has been, or the S&P 500 has been successful throughout the years. The environment around is the issue. Because if we didn't have any issues going on geopolitically in East, then we wouldn't be experiencing this issue. But this is where it makes sense for people like you and me. If we had invested years ago, then we must have invested a certain money when the S&P 500, specifically Boo, was at 400 or 500. Right now, Boo is oscillating between the 600. So because you have stayed invested for a very long, then that means you are still in the green. But now you're able to buy S&P 500 at a much cheaper price because at its high a couple of months ago was at 640, I believe, and now it's oscillating between 600. So the market is at a discount. If you want to buy, jump on the bandwagon and be aware that you don't have to react emotionally to market twists and turns. If you don't sell, then you are doing what long investors do, which is just holding solid and enjoying the growth and the dividends, even though they're modest. Dividends are. But just know this is not the first time we experience issues like this. We see the risks like war escalation, oil increases, which has always been an issue, a reoccurring issue throughout the years, and the market could drop even further than where it already has. But we should also understand that markets historically recover from these geopolitical issues. Understand that even though prices may be corrected in terms of the market, in terms of the stock market, just know that if companies are doing well in itself, like financially, then that will still support stocks even though prices have adjusted. And so to end this topic, I'm not saying that S&P didn't suddenly just become investment, just that the world has got certain that are getting screwed because of it. It's not just the S&P 500, it's not just oil, it's not just all of these things that screws us over in the meantime or temporary. And so all I want to say to end this video is to keep in mind that it's still gonna get a bit iffy in the upcoming months. We don't know what's gonna happen. We don't know if the markets are to sit down or up. All we know for certain is that these issues aren't unique to this time period. period. It's just like this has happened in the past. Right now, it's more well known because of how well social media pushes these videos to our feeds. So it's a lot more immediate to us, and especially because we're adults. So we're the ones who are mainly affected by this issue. Already we spend money left and right. We earn money left and right. And so when things start to become unbalanced, that's when we start to feel all this crap. And so I want to end with that. Keep investing, keep bracing, and keep holding on, and try to figure out a way to earn a second source of alright then, fellas.